First, we start off with the China wreck. The Shanghai Composite having its worst week of the year after what has been an epic rebound for Chinese stocks. This after its government said it would pare back stimulus for the economy. At the same time, companies here in the U.S., like 3M and Intel, have been pointing to a renewed slowdown in China, impacting their earnings. So is this China's warning to the world? And with U.S. stocks at all-time highs, can the rally continue if China pumps the brakes?
Well, it's interesting. I mean, I've been looking for a reason for our markets to go low for a while. This is as good a reason as any. But you go back to sort of last summer when the Chinese market started to go down in earnest. We probably lagged them by, 2.5, 3 months. So if this is the beginning of something, maybe we're finally looking at the sell-off late May, early June. But this is a 1 week situation. Markets down 5% after rallying 35%. I don't want to make a big deal out of it. I happen to think the Chinese will continue to throw as much money at their markets as they need. With that said, the commentary from Intel, from M, it has to be concerning. I know the S&P is effectively at an all-time high. Everything looks great. But beneath the surface, there are clearly some problems.
But then we have Ford saying that the Chinese market is stabilizing.
Nuts, right? Starbucks.
We have Starbucks, exactly. So for every one negative data point out of earnings on China, you got the positive.
Well, you're going to get a big one. I mean, we started the year out on January 2nd where Apple dropped the hammer on Chinese demand as it relates to their products. And that really got things going, I think, a little bit. Obviously, that worked into the bottom that we saw. I think it's really important to focus on the stimulus. Like you said, that's why the Shanghai Composite sold off, fear that they're going to kind of pull back from that. Think about what they did. They kind of had to do that, just like global central banks had to get more dovish, had to pivot over the last few months to orchestrate this sort of rally in risk assets. I'll just make one point, though. You have the dollar index, the Dixie, at 98, at a 52-week high. You have the 10-year Treasury yield below 2.5% again. Those two things don't speak to some level of confidence as far as global growth. We know that the IMF had cut global growth expectations earlier this month to below 3%. So if China's 6.4% for 2019 growth is going to be less, that's going to be a problem for the global economy. It's going to be a problem for risk assets.
I think it's a really good point about the dollar. You think about the dollar as the largest, or the Chinese currency is the largest component of the trade-weighted dollar. So if China actually does pull back stimulus a bit, I think they might pull it back, not eliminate it. But if growth is okay and they pull back stimulus, that probably supports the Chinese currency, which probably on balance weakens the dollar. That's probably good for multinational earnings, as long as the Chinese story isn't falling apart, and I really don't think it is at this point.
Aaron, you worried at all?
5% is a big move, but to your point, it's off a gigantic move, right? Mm-hmm. So I think if you just step back a little bit, when was the last time they were there? I don't know, very recently.
Yeah.
Right. So I don't know that you can really, to me, the more important data of the day was our GDP number, which, everyone thought there were so many reasons why the quarter could be bad, weather, terrible, the government slowdown, and still to have this number, that's pretty amazing. So I don't know if you talk about a global slowdown. I think we're big enough to sort of help others out.
So here's a question.
I like when you ask questions on fast money.
So China's central banks, China's government unloads a lot of stimulus into the economy to help it as well as the markets. The markets go up. They say, you know what? Oh, it's working. It's working out so well. We're going to take our foot off the pedal here. Could we have parallels here in the United States when it comes to the Fed and staying on the sideline? To the point where the markets.
I have a very strong opinion on the Fed. They are gone.
They're gone.
Fed is gone. It is not. When you look at what they said, they used to say data dependent. That makes sense. They're not even saying data dependent anymore. They're saying patient, which patient means is even if data doesn't go the right way, right? Even if data is hot, we're not going to do anything. We're going to go past this 2%. We're going to take, we had symmetrical below 2. We're going to allow it to go above 2. And yet you see some of the inflation numbers are actually down. Even with this GDP up, the Fed is gone.
It's interesting. I mean, there is inflation. There's asset inflation, ridiculous asset inflation. There's clearly energy, there's healthcare inflation. There's inflation in all the wrong places. But Karen's right. In terms of the Fed, I mean, I'm going to offend a lot of people here. They are data dependent. They're dependent on the NASDAQ going higher and the Dow Jones Industrial Average going higher. That's their data. And if you don't think it's true, just go back and look what happened in October into December. I mean, they turned on a dime because our market sold off. So by that definition, they'll never move. They can't move. But for Larry Kudlow, who I like as a friend and respect as an economist, for him to say after a 3.2 GDP print, however we got there, that there's still room for a rate cut, That's absolute madness.
Well, economists
Madness.
might be generous there. I mean, let's be frank. I think maybe you want to call him a strategist or something like that, a political strategist. I mean, let's be frank, okay? We were just talking on the desk last night about Amazon. We were talking about inflation. What did they just do? They said they're going to use a portion of their profits, okay? So their EPS is going to be less, right? And they're afforded to do that because stock market has been bid up because interest rates are so low. And what happened? They're going to get you their goods faster. That is a disinflationary thing. Did you guys see Target down 5% today?
Yeah.
Did you see Walmart down 2% today? Those three companies have been massive disinflationary forces in this thing. So we may never get to these inflation targets. They can whine about what needs to be done to get it back up. It's never happening again. So, to me, I mean, he's a phony economist, in my opinion, and we shouldn't be listening to that sort of
stuff.
stuff.
So that inflation argument, does that say that then he's right? We should cut rates?
No, because it doesn't matter. Unless we are going to be locked in this world. Karen, think about this, okay? In 2008, Fed funds was at 5.5%. In 2000, when we topped out, it was at 6.5%. So here, we just topped out at 2.5%. And these guys want to go lower. And look at how much sovereign debt is in negative yielding territory all over the globe. So they're talking about a whole new economic regime that the world has never seen. And this economist is going to be at the forefront of this, speaking against everything he's talked about for the last 25 years.
Well, and to bring this back to what the Fed might do, I hate to say it, but I feel like this GDP report is Goldilocks. It was good enough to keep the recession fears at bay, but you end up at a point where 165 basis points of the GDP report was trade related and it was inventory build. So I think the Fed during the next meeting, they can point to stable growth, but it also gives them cover to be dovish enough. So I think that's probably what they're likely going to do.
And the inventory build is absolutely, and it's fine if there's demand on the back end. But if we're pulling all this forward and the demand isn't there, and we're hearing, to Dan's point.
Yeah, but we saw that exactly last year in the first half of 18. A lot of that GDP was inventory build in front of these trade headwinds.
It's exactly. Okay. So that's could be problematic. Could be very problematic. But right now, everybody seems to be extraordinarily happy with the print and where the economy is.
So given all of this, where should we invest at this point? We're almost halfway through earnings season, Jeff.
Yeah, I mean, the question is, can the markets go higher at these new highs? I don't want to be blindly bullish because the biggest drawdown we've seen this year has been a little over 2%. You go back over the last 40 years, there have only been 2 years that haven't drawn down more than 5%. So we should mentally prepare ourselves for higher volatility. We have to. But I still like the breadth of the market. It's not just FANG leading this market higher. You have 45% of stocks in the S&P 500 above 20% right now. To me, that feels pretty good.